There could be bigger opportunities in the field, but if they exist, there will certainly be a lot of chaos in real estate financing. The esteemed financial advisor Warren Buffett said when asked about the real estate market. He also warns that a storm is heading its way for the real estate market, resulting in a $1.4 trillion tsunami waiting for this particular market, and you can already start seeing its effects. In such times, is it smarter to keep sending your money into a black hole, or is it time to find new alternatives? Let's find out. There was a time when real estate could be one of your best bets as an investor, a time way before all the cryptocurrencies and digital wallets. Then why is the market dying now? One of the main reasons is a housing bubble. The Federal Reserve Bank of Dallas has raised caution, suggesting there might be signs of a housing bubble looming over the United States. This isn't about homes suddenly becoming unaffordable due to skyrocketing prices online. The concerns delve into various aspects, including changes in people's incomes, the costs associated with obtaining credit, disruptions in the supply of homes, and the increasing expenses of constructing and maintaining houses. These factors collectively contribute to a steady and sustained increase in home prices. Now, what makes the situation potentially risky is the psychological aspect among home buyers. If many people start believing that home prices will continue their upward trajectory, a fear of missing out phenomenon may kick in. This fear-driven mentality can surge home purchases as buyers rush to secure a property before prices climb even higher. This heightened demand, fueled by the belief that prices will keep rising, can drive prices higher, creating a self-fulfilling cycle. The worry is not just about the numbers on the price tags of houses, but also about the reason behind those numbers. Suppose people start buying homes primarily out of fear or FOMO that they might miss out on future price increases, rather than because of genuine need or long-term planning. In that case, it can create an unstable situation in the housing market. Then there's mortgage rates and the availability of the houses. Firstly, mortgage rates are higher, making it more expensive for people to borrow money to buy homes. This situation, combined with inflated home values, means that purchasing a house might become less affordable for many. The prices of homes have gone up, and if mortgage rates continue to climb, it may limit the number of people who can afford to enter the housing market altogether. And even if, by some miracle, someone has the means of buying a home, there's another concern related to the scarcity of these available homes. The problem is there aren't enough. This limited roster leads to fewer houses for sale, and when demand is high, it can create a competitive environment where prices may be driven even higher. This, in turn, raises concerns about the overall affordability of homes for potential buyers. This deadly combination of expensive mortgages, high home prices, and a shortage of available homes makes buying houses tough. Charlie Munger, vice chairman of Berkshire Hathaway, goes on to say, by its nature, real estate tends to be a very lousy investment. So, in such a situation, what alternatives can you turn to? Number 1. The stock market. The stock market tends to be more lucrative than the real estate market. Investing in stocks will ultimately diversify your money, and let's face it, the potential of growth in the stock market is crazy good, mainly because the hassles are less. It's easier to hold on to your investment when you're not trying to buy and sell the stocks. You buy mutual funds and forget about them. You don't need to be hands-on with it like you would have to be for the real estate property. Though the cash flow may surpass stocks if done right, the main reason behind this is that the real estate market is unique and almost imperfect. In contrast, the stock market gives you the perfect market where all the buyers and sellers have the same information and access to buy. Number 2. Cryptocurrencies. Next up, cryptocurrencies like Bitcoin and Ethereum have gained popularity as alternative investments to real estate. These are virtual currencies that operate on blockchain technology, ensuring decentralized and secure transactions. Think of blockchain technology as a record-keeping system. Unlike investments in real estate, it's spread throughout a network, and its transactions are safe, transparent, and secure without any chance of manipulation. One major factor that attracts investors to cryptocurrencies is their potential for rapid and substantial returns. Unlike real estate, where the growth of property values may take time, cryptocurrencies have shown the ability to experience significant price surges in a relatively short period. Additionally, the accessibility and global nature of cryptocurrencies allow for 24/7 trading, fostering liquidity and flexibility that real estate markets do not have. You know it's a solid investor when the founder of BlackRock, Larry Fink, plans to take over it. Number 3. Bonds. Bonds offer a more reliable alternative to the real estate market, which, in comparison, is nothing short of a roller coaster ride. Bonds are like these loans that you give to companies or governments in exchange for regular interest payments and the return on your initial investment when the bond matures. This offers fixed income security and is regarded as a more stable investment than real estate's sometimes unpredictable nature. With bonds, you know what to expect: regular interest payments and the assurance that, barring any default, you'll get your capital back when the bond reaches maturity. This reliability can be quite appealing, especially if you prefer a smoother ride compared to the ups and downs of real estate. While the returns might not skyrocket like some riskier options, bonds offer a reassuring level of security, making them a solid addition to a well-rounded investment mix. Goldman Sachs Asset Management CIO of Public Investing, Ashish Shah, tells us how 2024 will be the year of bonds. JP Morgan's Asset Management, Kelsey Barrow, also put forward her views about the Fed's inflation fights and what it means for the bond market. Number 4. Gold and other precious metals. You must have heard the phrase, "all that glitters is not gold." Well, in this case, it definitely is. Gold or silver can be great investments. These shiny metals sit pretty and are considered safe haven assets due to their essential value and resilience. Unlike real estate, precious metals don't rely on the complexities of markets or economic conditions. They act as a hedge against inflation or any other financial turbulence. In times of economic instability, investors often turn to gold and silver, making a more reliable store of value. The gold or silver appeal lies in their tangible nature and that they're not subject to the same market fluctuations as real estate is. While real estate requires ongoing management and may be influenced by location and market trends, precious metals remain relatively stable, providing a straightforward way to diversify your investment portfolio. Robert Kiyosaki is a big supporter of investing in gold. In fact, his first investment was a gold coin that he bought for $50, now priced at $2,000, and he still has it with him. Number 5. Real assets. Last but certainly not least, we return to traditional real assets such as farmlands or timberlands. Farmland represents a tangible and essential asset, as agriculture remains a fundamental part of our economy. On the other hand, timberland offers a unique aspect of renewable resources, with the potential for growth and sustainability. Unlike residential real estate, these real assets often have intrinsic value and serve practical purposes. They also offer a chance to diversify your investment while contributing to essential aspects of society. Warren Buffett stands huge on real assets such as farmlands. He's known to repeatedly sell his opinion about the validity and advantages of real assets such as farmlands as an investment. This is what he had to say about them in a conference meeting. Although the real estate market is set to say its goodbyes, the newer and better alternatives remain. If you have some other investment alternatives in mind that we missed, do tell us in the comments below, and as always, don't forget to like and subscribe. What can we expect from the stock market in 2024? A bull run or a storm? Join us as we unlock the thrilling mysteries in the heart of Wall Street's crystal ball. The majority of Wall Street believes the Fed will succeed in providing a soft landing for the U.S. economy. In other words, slower economic growth without a recession should result in interest rate reductions in 2024. In that context, greater corporate earnings growth for S&P 500 businesses is anticipated by most analysts. Regarding the performance of the equities in the upcoming election year, estimates for the S&P 500 in 2024 are highly divergent, but the general agreement seems to be that gains would be between 8% and 9%, which is slightly less than the index's historical average of roughly 10%. Artificial intelligence is predicted by many to be a major subject of investment in 2024, among other things. 2023's market highs, 2024's January uncertainty. The expectation of a fantastic 2023 drives the stock market into the new year. The Nasdaq Composite closed the year with its fifth best yearly result. This recovery was especially appreciated following the index's 33.1% decline in 2022. Given the 43.6% surge in 2020, the Nasdaq is currently on track to see two of its six greatest years ever in the current decade. In 2023, the S&P 500 increased by 24.2%. That is more than twice the average annual return it has historically had. It also made a good comeback in 2022 when it lost 19.4%. November and December saw an acceleration of stock market gains, with the Nasdaq and S&P 500 rising 16.8% and 16.2% respectively. For both indexes, November's monthly advances were the most since July 2022. The Dow Jones Industrial Average, along with the two indices, were at or very close to record highs at the end of December. However, the Nasdaq and S&P 500 have been on protracted losing streaks during the first week of January, telling a different story. S&P 500 estimate. Despite persistent pressure from rising interest rates, Wall Street experts predict S&P 500 earnings will continue to rise in the upcoming quarters. According to analyst estimates, S&P 500 earnings increased by 4.1% year-over-year in 2023's third quarter and are expected to increase by 3.2% in the fourth quarter. Analysts predict the S&P 500 will rise even more in the upcoming year. For the S&P 500, the average analyst price target is currently $5,038.15, indicating more gain in the upcoming 12 months. Energy stocks are expected to rise by an average of 21.6%, according to analysts who see the industry progressing. With just 12.3%, analysts predict the utility sector could have the least potential S&P 500 to next year. Dow Jones forecast. Should the inclination toward growth companies and tech firms persist in 2024, the Dow Jones Industrial Average is expected to underperform. However, if a recession hits the U.S. economy, investors might turn to blue-chip companies for protection. Salesforce, Microsoft, and Intel are just a few of the technology firms that have been among the Dow's greatest performers in 2023. Stock Market Prediction 2024 AI Stocks. The enthusiasm surrounding generative artificial intelligence, or AI, in 2023 led to significant investments in the software, computer hardware, and semiconductor industries.
And we think they're going to have a great year in 2024 as AI takes hold on the consumer side. So, we'll see, but they look encouraging.
Notably, NVIDIA became the clear leader after seeing an incredible 238% increase in the value of its shares, confirming its position as a key participant in the AI space. NVIDIA's remarkable rise in sales and profits was mostly driven by the need for graphics processors and data center technology, especially for AI products. In the third quarter of its fiscal year, the corporation reported earnings that were 593% higher than expected, and sales that were up a startling 206% to $18.12 billion, above Wall Street predictions. Experts predict a move in 2024 toward the use of AI in a variety of industries, with an emphasis on investments that will increase production. The Magnificent Seven, C3.ai, and Palantir Technologies are a few important AI stocks that are significant participants in the changing AI market. The Magnificent Seven and the stock market outlook for 2024. The performance of the Magnificent Seven, Amazon.com, Alphabet, Apple, Meta Platforms, Microsoft, NVIDIA, and Tesla had a significant impact on the stock market in 2023. These seven firms had a significant impact on the market. In fact, they accounted for more than two-thirds of the returns that the S&P 500 had over the year. Even though they account for over 30% of the market value of the S&P 500, their total weight is greater than that of any other seven companies in the index's history. Notably, weaknesses are beginning to show in this potent group. Alphabet and Amazon are trading below previous purchase prices, and Apple is below its 50-day line. As of January 4, though, Meta is stretched from its breakouts. Tesla is very close to a fresh buy mark, and Microsoft and NVIDIA are still in buy ranges. The Magnificent Seven still hold a great deal of market share and attention despite possible obstacles. Inflation and the stock market. Investors have been primarily concerned about inflation since the beginning of 2022. Despite notable advancements on the part of the Federal Reserve, inflation is still far higher than historical averages. For the third consecutive month, September saw a 3.4% year-over-year increase in the Personal Consumption Expenditure Price Index. The Fed's preferred inflation indicator, Core PCE, which takes volatile food and energy costs out of the equation, increased by 3.7% in September, much above the Fed's objective of 2%. Fed Chair Jerome Powell expressed his no confidence that the Fed has taken sufficient steps to return inflation to a long-term trend of 2% during a speech to the International Monetary Fund at the beginning of November. The Federal Reserve has cautioned investors that interest rates might stay higher for a longer period until it is certain that it's tightened monetary policy sufficiently to keep inflation under control. Elevated inflation is still a concern. Since March 2022, the Federal Open Market Committee has increased the range of its Fed fund target rate many times, from 5.25% to 5.50%. Increased borrowing costs for businesses and consumers reduce profit margins and hinder economic expansion. The FOMC projects that the growth rate of the U.S. GDP will decrease to 1.5% in 2024 from 4.9% in the third quarter of 2023. In 2023, the main conversation topic was about how resilient and powerful consumers were, and everyone was anticipating a recession, which never materialized. However, the focus may move to inflation in 2024, either steadily returning to the target or becoming stuck, causing the Federal Reserve to lower interest rates than anticipated by the market. Prediction for the stock market in 2024, the presidential election. The coming election in November will have an impact on the stock market projection for 2024. The S&P 500 has historically increased in re-election years, with the exception of 1960, 2000, and 2008. According to the Stock Traders Almanac and Comerica CIO John Lynch, the tendency indicates that robust economic and market performance match voter sentiment. How to invest in the 2024 stock market. The likelihood of a harsh economic landing has decreased in 2023, but difficulties still exist. According to the New York Fed's recession probability model, there's a 46.1% possibility that the United States would have a recession in the upcoming year. There could be obstacles to the S&P 500's upward momentum until 10-year Treasury rates exhibit a definitive peak. Rejecting developing world stocks to neutral and raising U.S. equities on the strength of increasing corporate profit forecasts and economic indicators, LPL Financial modified its view. The company advises a tactically neutral allocation to stocks with a little overweight to cash-based fixed income. According to Ryan Dietrich, chief market strategist at Carson Group, S&P 500 corporations expect record profits in the upcoming year, which lends credence to the bull market's continuation in 2024. I hope these predictions will help you invest in 2024. If you found it interesting, give us a thumbs up and subscribe to our channel for more content like this.